because you have that capability to perform that work. So that is how it has to be looked at.
Excuse me. In the case of Amazon.
Sorry, if you don't mind, I need to complete the rest of the slides. I will take questions again from everybody for the last 10 minutes, but allow me to complete if you're okay. So on definitional issues of intangibles, what are intangible assets and how are they different from value drivers, for example, in a business? For something to qualify as an intangible, does it need to have commercially transferable interest? How do you deal with legally protected intangibles versus intangibles which are not legally protected, which can be in the form of customer relationships, for example, or which can even be in the form of know-how which is consciously not registered or patented to keep it secret, because once you register or patent it, it comes out in the public domain. What about goodwill? How do you deal with goodwill? Should goodwill be only taken into account for transfer pricing purposes whenever there is a business transfer, or should it also be taken into account otherwise while setting prices? Marketing intangibles. When are marketing intangibles created? There is a lot of confusion on that. When are marketing intangibles relevant? And if they are relevant, to what extent they should be factored in price setting? What extent they should result in a higher or lower profit being paid to one of the entities in the value chain? What about workforce in place? When people are moving across continents, and that happens because factories are shifting locations, for example. So a foreign company says, India is becoming too expensive. We want to shift the manufacturing plant from India to, say, Philippines. Is there a transfer of an intangibles? Because that plant, there would have been capable and highly intelligent people who would have been employed by that plant, and some of those people will move. How are group synergies required to be treated? Does it have a place in transfer pricing analysis? Those are kind of questions which are being really asked. Developing TP rules for to ensure that transfer and use of intangibles are appropriately allocated in accordance with value creation. Now, the point here is that who in transfer pricing should be entitled to intangibles related returns. Okay. Now, here the issue is to first identify what is an intangibles related return. So let's take an example. Let's say there is an Indian company. That Indian company is a licensee for the Indian market. Okay. The foreign company is the legal owner of technology, for example, and the foreign company licenses that technology to the Indian company. And the question is that the Indian company has to pay some royalty. Now, how do you really determine the right royalty rate? Now, if it's a very routine intangible, you would probably find comparable license agreements and give it the same royalty rate as other comparable license agreements are showing. But there lies the misnomer that in real life, no intangible is routine. Every intangible is unique. Otherwise, it would not be an intangible. So then, in that case, if let's say hypothetically the Indian company is earning a profit of say 25% on sales, right? Now, some part of this 25% profit is attributable to the functions that the Indian company is undertaking. So let's say that Indian company is doing manufacturing and distribution and sales. So let's say if a contract manufacturer earns 5% margin on cost, and let's say a distributor earns 4% on sales, let's say hypothetically the total return that India should get for its routine functions of manufacturing and distribution and sales is let's say 9%. So now you have removed 9% from 25% and you are now left with say 16%. Now who does this 16% really belong to? That's the residue that has remained in the value chain, which is in the form of super profit. The first step is to identify that how much of 16% belongs to India, because as a licensee it is exercising decisions on strategy. So some part of that 16% should belong to India and some part of that 16% is contributed by the foreign company, because it is giving an intangible which is allowing the Indian company to earn that extra profit. So that's where you go into sophisticated profit split type of models, when you have hard to value unique intangible assets where value is being created on both sides. So here was an example where the intangible itself was extremely valuable, that allowed the Indian company to make 25% profit, because making of the 25% profit is itself not common. Not everybody makes 25% profit, which means that surplus which is getting created, it is getting driven on account of something. That something could be use of an intangible, or that something could be use, management insights or strategy. So once you have first allocated routine returns for manufacturing and sales, and in my example it was 9%, the surplus of 16% has to be then split. Some of it will remain with India, because India is exercising strategy, and some of it needs to go out to the IPO round. So that's the whole question on how do you really identify intangibles related returns. Okay. The second issue is that when you say that return for intangibles should be commensurate with value creation, you also are looking at, once you have identified what is that intangibles related return, who should that intangibles related return go to? Should it go to the legal owner of the intellectual property, or should it go to the economic owner of the intellectual property? And now the OECD has said in its intangibles draft that just because you are a legal owner, that by itself will not entitle you to get intangibles related returns, unless you can show that you are performing functions that create those intangibles, you are performing functions that manage or take decisions on how to exploit those intangibles, you are performing functions to protect those intangibles. You are incurring costs to undertake those functions, and you are bearing risks as an outcome of those functions. If you can show all of these things, then you will be the legal as well as the economic owner of the intangibles, and only then you will be entitled to intangibles related returns.
What do you mean by economic owner?
The party who has spent the money to develop that intangible. So this again is a big issue in transfer pricing, and even OECD Working Party 6 has not been able to find out the answer to this. That hypothetically, let's say in a cost contribution arrangement, and cost contribution arrangement is an arrangement where 2 or 3 parties come together and they say that we'll develop this intangible together. And one party puts in human resources in the form of scientists, other party puts in money, and the third party puts in, say, platform intangible rights, which are base rights on which you will develop something new. In this situation, what gets more weightage? Because if you really look at it, even the party which has put in money has undertaken significant amount of risk. So today the view of the OECD on this is that just financing by itself is not sufficient to give a party an intangibles related return. At best you can give that entity a financing return, and if that financing return is not commensurate with the risk that is being taken by the financier, then you have to risk adjust that return. You maybe increase that return a little bit, take into account the risk, but the financier will still not get profits associated with exploitation of intangibles. Okay, so those are some of the principles which are getting tested. There are no clear answers on these things right now, but the push and pull factors between functions on one side, pre-existing intangibles on the other side, and financing on the third side, in terms of who gets to keep the profit, is a big issue in transfer pricing. Updating guidance on cost contribution arrangements, I just gave you that example, which is the same point over here. So this is the parallel work that the OECD is doing, and somewhere the OECD has mentioned in the in BEPS document that there is a fair bit of overlap between the action point number 6 on intangibles and the work that is already being done on intangibles separately. And therefore OECD has said that the second discussion draft that was issued in July 2013 should be only viewed as work in progress, and at some stage they will converge the 2 work streams together to harmonize them. We talked about some of these things. There is a new section now in the intangibles draft discussing local market, location savings, assembled workforce and group synergies. We touched upon it a little earlier on local market advantages and location savings. And there the principle is that if for something to qualify as an intangible, it needs to be unique, and it needs to confer a unique competitive advantage. It's only then the market will be prepared to pay you a premium. If that uniqueness is not there, and if that locational advantage is generally available to everybody, then it can only be addressed through comparability considerations, and it should not be factored separately into pricing. Explanatory changes to the definition of intangibles. We talked about definitional issues earlier, so some of those things the OECD is going to discuss in the intangibles draft. What do you mean by intangibles related returns? There the OECD is essentially looking at between significant people functions, between financing, who gets to keep the money, net. New transfer pricing section on transfer pricing aspects of use of company names. Let's say, for example, you have subsidiaries in the US market, and by default those subsidiaries carry the names of the parent company. Should that require a separate charge? That's again a question which is being looked at. Reorganization of guidance on methods and comparability analysis. Now again, for intangibles, most of the methods that you have in transfer pricing will not always apply. So profit-based methods will generally not apply. You would usually look at cups, but again the comparability criteria for cups is very, very stringent, and therefore because inherently intangibles are unique, you will never have a cup. So, or there are few situations where you will have a cup, unless a certain royalty agreement is also there by the same party with a third party. So if your parent company, let's say, has a license agreement with India, but in China they don't have their own subsidiary, so they operate through a third party, and in China they may have given a similar license in favor of a third party, that can be a cup. But generally outside, you will have few situations where you have genuine cups for intangibles. In what circumstances the profit split method should be used for dealing with intangibles? Profit split method is typically used when both sides of the transactions have non-routine intangibles. Okay, when you just have one side having non-routine intangibles, you would typically test the other side which doesn't have an intangible under TNMM. So the least complex entity is typically tested under TNMM. But what happens in a scenario where both sides to the transaction have unique intangibles? In such cases, you are left with no choice but to apply the profit split method. Work on hard to value intangibles reserved for further work as part of the BEPS project. So that's the work that is happening on the intangibles draft. OECD BEPS Action Point 9 extends the concepts of Action Point 6 to risks and capital. And there, the point over here is that the OECD is looking at preventing BEPS by transferring risk amongst or allocating excessive capital to group members. So the principle that OECD has always emphasized, even before BEPS became so important, is that you cannot transfer risks through a contract. You cannot, between independent third parties, say that this company will take all the risk and that company will be stripped of the risk, and therefore if that other company is stripped of all the risk, that company should get a routine low return, and whatever remains should go to the company that bears the risk. Today we've reached a stage where you just cannot transfer risks in a contract. Risks will attach to that company which has the functions which create the risk and the functions which manage the risk. Now, what do you mean by functions that create the risk? So the key word that the OECD has used is control over risk. What does it really mean by control over risk? What it means is that the entity which is taking decisions that put the capital of the organization at risk, that's the decision that is exercising control over risk. So let's take the example of a product launch decision. Foreign company takes the decision to launch a certain product in the Indian market. Foreign company is the parent company. The Indian subsidiary implements that decision, right? Now in this situation, the decision to launch a certain product has already been taken by somebody else outside of India. If that decision succeeds, then the profit attributed to that decision should go to that party who took it. If that decision fails, because that's the decision that puts the capital at risk. If the decision fails and the Indian company makes a loss, then logic would have it that part of that loss should go to the foreign company because the decision was actually taken there. So that is what OECD is trying to say when it says that how the risk is allocated between related parties has to be linked to who undertakes the critical functions that create the risk or that manage the risk. And for managing the risk, it is not necessary that you have to undertake those functions yourself. You can always choose to outsource some of those functions to third parties, provided you ensure that you ultimately control that function. So in a situation where the foreign company, let's say, does monthly review meetings, and they look at how the Indian business has performed, they give targets to people, and they pull up people for not meeting targets. When you have this kind of situation, that's the mechanism that the foreign company is actually putting in place to manage that risk. So those, and that's the reason why today you see that the so-called hybrid organizational structure is actually creating a whole lot of issues in transfer pricing, because in a hybrid structure it is very difficult to figure out who really took the decision and who should be entitled to entrepreneurial returns. And mind you, entrepreneurial returns could be a combination of people-related returns as well as intangibles-related returns. So that's really the controversy here.
The say Indian captive service provider who is 100% providing service to its parent company, there is no control over the functions by the parent company, but the contract is secured by the parent company. So in this situation, whether OECD is of the view that Indian company should get an entrepreneurial return?
No. So in this example of yours, it is the foreign company that is the market-facing entity. So it is the foreign company that goes into the market, fetches customers. It is a foreign company who is primarily liable to the customers. So if there is a service defect or a product liability that arises, it is the foreign company that will bear that risk. The foreign company also has market risk. Okay. The Indian company here has to execute instructions of the foreign company. So there are no entrepreneurial functions there. They are told what to do. There may be a statement of work or an SOP. An Indian company just has to execute. In this type of a situation, the function which creates the risk is sitting outside India. And therefore entrepreneurial returns will go to that company after the Indian company has been rewarded with a routine steady return for its functions. OECD BEPS Action Point 13 is on transfer pricing documentation. Now, here, what the OECD has recognized is that there needs to be consistency in the manner in which transfer pricing documentation is prepared by different governments. I'll come back to this slide again. But what is really the purpose of transfer pricing documentation? One is that it should be an enabler for the tax authorities to assess what are the transactions that require further scrutiny. So some sort of a risk-based audit. It should be an enabler for the taxpayer to demonstrate to the satisfaction of the tax authorities that his transfer pricing is all right. So your transfer pricing documentation should convey that. And your TP documentation should be start of an income tax audit. Those are the threefold objectives of TP documentation. Now what's happening around the world is that documentation requirements and documentation best practices around the world widely differ. So our documentation may require us to report certain things. Documentation in the other side may not require us to report certain things. Sometimes our tax authorities may expect Indian company to maintain information which may not even be relevant for transfer pricing analysis. So for example, when you have selected India as the tested party, and for example, when you show that there are no cups at all, how is it relevant? What are the prices at which US is selling to Russia, for example? But they will want it. So, and some of it is dictated by local transfer pricing rules as well, in terms of what a taxpayer is expected to maintain and provide and what they are not expected to maintain and provide. But there is a need for harmonization. One, because what's happening is that cogent information is not being reported so that tax authorities can start proper audit. And sometimes it creates a whole lot of information gaps, and that in turn creates transfer pricing challenges. So the objective of Action 13 is to come up with guidelines on what should be those documentation best practices. And this is still work in progress. Broadly, what the OECD has presented as a proposed solution is a two-tier structure for TP documentation. Now, what happens really is, let's take an example. Here, we prepare our own transfer pricing documentation. So you may either get a TP study done internally or you will outsource that to some consultant, right? Now that TP study presents the picture of what are India's transactions and what does India do and whether India gets rewarded properly for those transactions or not. But from the point of view of the tax authorities, does it tell the tax authority that how is India positioned in the overall value chain? To what extent is India important or unimportant if you look at the entire supply chain? Okay, that bird's eye view is never presented. So, as a reaction to that, what OECD is now proposing is that documentation needs to be prepared at two levels. At the central level, let's say in the headquarter company, you will have a master file. That master file will document information about your group. It will document which are the various countries where you have operations, what those countries are doing. Are they performing manufacturing? Are they doing distribution and sales? Are they doing R&D? Are they owning intellectual property? What are they doing? Okay. What are the key contracts that you have? Where is your place of effective management? Where is your decision making happening? Which entity is owning intangible assets? So that is the bird's eye view. Okay. And that bird's eye view, the OECD is now recommending that that big picture should be documented in a central master file. Okay. Once you have that big picture, then on a country by country basis, you can then supplement that big picture by documentation which is necessary for that local country. So the functional analysis of that Indian subsidiary can be there in the local file. It need not be there in the master file. Okay, based on the functional analysis of the Indian company, what should be the margin that it should earn? Part of local file, not part of master file. So that's the two-pronged approach that they are recommending. The other thing which OECD has recommended is this first bullet, which is creating significant controversy everywhere in the world, which is this whole thing of country by country reporting. Now what the OECD is saying over here is that as part of the master file, they want taxpayers to report topical information about their global operations. So what is required to be reported? Okay. What is required to be reported? And right now they have just said that this recommendation that the OECD has made does not represent the consensus view of the OECD nations. So they have invited comments from different stakeholders. So a lot of water will flow before this is actually formalized. In fact, there are many nations which have actually resisted this significantly. United States, for example, is saying that the moment you start reporting your global information in the form of which country is making which margin, what is the sales of each country, it is going to lead to formulary apportionment. Tax authorities will say your global sales are broken down into 15 countries, let's break down your global profits into 15 countries in the same ratio. That's formulary apportionment. United States has asked the OECD to give a commitment that this data, if reported, first there has to be a commitment that this data will not be used to formularily apportion profits without applying the arm's length standard, because it will be completely ridiculous to do so. So, what is this data that is that is being expected now? They want companies to present this information for all their associated enterprises. Present this information for all associated enterprises in a consolidated place. So OECD has actually come up with a template for this. This template will evolve. This is currently a draft template. But what this template effectively requires is the following. That template requires every associated enterprise in the world, including permanent establishments that are treated as separate taxpayers, to report the following. You are required to report where does your place of effective management lie. Okay, and there OECD is going back to the definition of effective management as per Article 4 of the treaty. Okay. They want you to report what they've assigned some activity codes. So they have assigned activity codes for manufacturing, procurement, distribution and sales, R&D, IP ownership, insurance, financial transactions. And you have to, in that template, against each entity, mention the activity code, which will signify what that entity actually does in the entire value chain. Okay? They want each entity to report the sales of that entity. So sales to related parties and sales to third parties. including other income. Okay. They want entities to report earnings before interest and tax. They want entities to report the tax actually paid on cash basis. And they are saying that it should be reported into 3 baskets: tax paid to your own government, tax paid to other government, and withholding tax deducted against income payments made to you. All that has to be reported. They want companies to report their total employee cost in each country and total number of employees that they employ in each country, including secondments. It doesn't matter where that employee is actually performing his work. He may be on Singapore payroll but performing work in India, but Singapore will have to report it. So that's the level of information that they are actually asking in this template. Now, there are a whole host of issues around this, and there are really no guidances given by the OECD. The OECD has recommended that you have to follow statutory financial statements while giving this information, which also means that when you report this information in a massive template, the numbers will not be comparable, because India will report profits for March 31 year end, US will report for December 31 year end, India will report in rupees, US will report in dollars, accounting conventions will also differ, so there may not be full comparability of this information. And clearly at this point OECD is not really dictating this way or that way. They have left it for stakeholders to comment on how they would want to report this. So this is another big thing that is happening. We do not know at what stage this will hit India, but somewhere this is going to come to India at some stage, where our own tax authorities will use this template, devise their own template and notify something. And the key here is that while OECD has clearly said that the objective of this kind of reporting is not to substitute a proper transfer pricing audit. This is just meant to be a starting point so that tax authorities can know where to focus on. But that does not mean that this should be a replacement for a TP audit. So just because some other country is showing higher profits and India is showing lesser profits, that does not automatically mean something is wrong. Okay. While OECD has cautioned this, on the ground you know very much how it will progress. So this is being viewed as something which is a significant development, which will cause a lot of controversy as we go forward. General anti-avoidance rules and transfer pricing. So here I'm not going to focus on the theory around GAR. I think much has been spoken and discussed about GAR. But what we will talk about here is to what extent GAR and transfer pricing really interplays. Okay. So what does GAR really say? Just few minutes there. That GAR seeks to attack impermissible avoidance arrangements. What are such arrangements? They are arrangements which are entered into with the primary motive of tax avoidance or obtaining a tax benefit, where one of the objects or part of the object is to secure a tax benefit, and any of the 4 conditions are satisfied. Okay, creates rights and obligations which would not normally be entered into if the transaction was implemented at arm's length, results in directly or indirectly in the misuse or abuse of provisions of the code, lacks commercial substance, or is not for bona fide purposes. Now let's just stop here before we go any further. If you look at our what the OECD has been saying internationally in terms of in what circumstances tax authorities should be allowed to disregard transactions completely. Okay, OECD says that it should be in very rare circumstances that the transaction as actually undertaken by an entity should be completely disregarded. If there is non-arm's length behavior, OECD believes that as far as possible such non-arm's length behavior should be addressed through pricing adjustments and not by redrawing the lines between the boxes. Okay? And OECD is of the view that in many situations, taxpayers undertake transactions which are generally never undertaken or will never be undertaken between third parties. Okay? Now that does not by itself mean that something is necessarily wrong. So let's take the example of a low-risk distributor. Now low-risk distributor as a concept is there in transfer pricing.